Hello and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. Today is March 21st. It is 9:36 p.m. Eastern Standard Time. And today I kind of want to talk about inflation. It's been getting a lot of coverage lately. There's, talk of the amount of money that the government is spending in stimulus, along with the ultra accommodative stance that central banks, monetary policy authorities, and a lot of the developed world are still taking. There is a narrative developing that we can expect increased levels in measurable inflation. Now, inflation is basically the rise in the general level of prices. By itself, inflation is not necessarily a bad thing, but just like with most other things in life, too much of it is not a good thing. Too much inflation, you have hyperinflation or runaway inflation. That's not a good thing, where prices are rising so quickly that consumers are having a hard time keeping up with the loss of purchasing power of the money, and they have a hard time purchasing goods and services because prices are rising so quickly that their wages just cannot keep up. When we have situations where the cost of living is increasing, so what we see in the United States, for instance, where slowly over time prices have been going up. It's just they've been going up slower than the long-term expected rate set by the Federal Reserve, which is about 2% annually. For the past decade plus, basically, for the duration of the response to the Great Financial Crisis, 2008 through 2010, we've basically seen what can be considered a disinflationary period, which is positive inflation, but it's becoming less and less positive as time goes on. So inflation is increasing, but the rate at which it's increasing is slowing. It's kind of a second derivative type of analysis. The idea that cost of living increases can outpace wages, it's not a good thing for consumers, of course, because the cost of the goods and services that they normally purchase are going up, while their wages aren't keeping up with it. But for the financial industry, that's a beautiful dynamic. I say that because people are going to be people, consumers are going to be consumers, and they're going to want to consume. And if their wages aren't allowing them to keep up with the cost of living, they'll simply have to borrow the difference and finance it. That's perfectly acceptable for companies in the financial industry, and also for investors in those companies in the financial industry. Now, moving on to the trade book. I've chosen to simplify my approach in the trade book because I realized there's an opportunity in two asset classes in particular that I track to establish a longer term, more macro position. And those two instruments, or those two asset classes, are gold and stocks. And the vehicles in which I've chosen to express that trade are the GLD ETF and the SPY ETF. So just to be clear, the position in gold that I'm building, is a pure inflation expectation play. And the idea behind that is, as investors' expectations about future inflation catches up with the forward guidance that both the Federal Reserve and now the ECB are providing, explicitly stating that they will allow inflation, realized inflation, to rise above and stay above their long-term targets for an undefined period of time suggests to me that over time, investors will be okay with paying higher prices for assets. So, as a pure inflation expectation play, I am establishing a position in gold, and the idea is to hold on to these positions as investors are willing to pay more and more for inflation sensitive financial assets, gold being one of them. The S&P, the narrative is a little bit more layered, but still also an inflation expectation play. So the idea is ultra accommodative monetary policy, and especially quantitative easing exercises, have flooded financial markets with excess liquidity, and as part of the transmission mechanism have been pushing up, among other things, stock prices. Bond prices as well, but in particular, stock prices. Central banks typically target interest rates on the front end of the curve and only try to manipulate the longer end or middle of the curve when they're trying to add additional accommodation and also provide liquidity and make sure that there is a buyer of last resort for, in particular, government bonds out 10, 20, 30 years. What we've noticed in recent trading sessions, as you've seen the moves higher in particularly the US 10-year Treasury yield, is the Federal Reserve stepping back from the longer term Treasury markets, or the middle and the longer ends of the Treasury curve, and letting those rates fluctuate, and in this case rise based on solely investor demand and government supply of those financial instruments. Now, to be clear, they're still maintaining the low short-term rates. So monetary policy is not adjusting short-term rates, just the amount of liquidity being provided out on the curve. So in the short term, stocks can be expected to be supported by lower discount rates, lower cost of capital in the short term, which benefits the companies that have to borrow. And as you see the longer end of the yield curve rising, so 10 years and out, you're basically seeing the discount rate that future cash flows have to be discounted to create a present value or today's stock price increasing. So on the short end, there's still the support from low interest rates being pinned to zero effectively. But as you go out on the curve and the curve steepens, longer term rates are rising. So future cash flows are discounted at higher rates, meaning that they have a lower present value. Those two forces working on the stock market suggest that the growth outlook on the S&P will be slowed by the steepening yield curve. But because again of the short-term rates being kept low, the growth outlook is still positive. Monetary policy is still stimulative. But it's just that the growth going forward as we move further along the yield curve slows because of the rising rates discounting those cash flows. But it is important to note that a steepening yield curve usually signals expected economic growth. So investors are expecting future returns, future yields to be higher than current ones. And in terms of the financial industry, again, the steepening yield curve benefits the banks because they get to borrow short or borrow our deposits and pay a low interest rate on it and lend long, or lend long term for mortgages, consumer loans, and charge a higher interest rate on it and keep the difference, the net interest margin. So for the sector investors that are looking at the financial industry, even with rising rates and rising inflation expectations, the financial industry is still poised to benefit from that because of two factors. One, cost of living increases outpacing wages, so consumers have to borrow the difference. And the steepening yield curve, which is the rate at which the consumers have to borrow for longer terms, is rising. So they have to pay more to borrow from the banks. The banks get to borrow themselves from investors on the short end for a lot lower or a lot less than they get to lend to consumers on the longer end. Coming off of last week, going into a new trading week, I liquidated my trading positions. The other asset classes that I look at have been fluctuating, which is perfectly fine because I can trade them. But because of the macro narrative that's developing around, in particular, gold and the S&P, due to inflation expectations, I think it is best to build a longer term position and try to capture the benefit of longer term macro moves in those positions driven by inflation and inflation expectations in gold and in the S&P versus trading short-term fluctuations or oscillations in the currency markets based around the dollar, as well as with oil, which the price of oil in the short and medium term can be unduly influenced by supply and production news releases from OPEC, Russia, and other large suppliers of crude oil. And then again, there's the sovereign debt market, in particular the U.S. federal government, and they're planning on spending a lot of money, trillions of dollars, most of which will have to be borrowed and more than likely borrowed for longer durations. So we can only expect more supply of longer dated U.S. government debt to be issued or supplied to the market. And because the Federal Reserve in particular is not really focused on being the buyer of last resort to make sure that there is a market for those government bonds, I think that will create volatility in the government bond market. But the overall direction more than likely is yields higher and prices lower. So 10-year treasuries, there's a directional bias with lower prices, but I still think there exist many trading opportunities. Similarly, with oil, I believe the bias is higher because of demand or pent-up demand versus the ability or the willingness of suppliers to respond to increases in demand in time to keep prices from moving higher in oil. And then, of course, the dollar. With investor sentiment fluctuating between risk on, risk off, and international capital flows moving into and out of the United States in response to changes in sentiment, the dollar doesn't necessarily have a clear direction. So again, I don't think there's a macro position to be established in the dollar, but because of its oscillation back and forth, it provides ample trading opportunities. So in the trade book, the only difference is I am establishing a longer term position in gold and in the S&P, but it is business as usual with the other asset classes and whatever correlation plays I can find off of those other asset classes, because there may be biases, but no fundamental narrative to support a long-term move in one direction or another in any of the other asset classes other than gold in the S&P. Now we can look at dashboard. For those that have been listening to previous podcasts, you will be aware that on the dashboard, I look at 5 things: crude oil, the 10-year treasury, gold, S&P, and the US dollar index. With the dashboard, I'm only looking at a week's worth of price data because the objective is to determine a short to medium term outlook for investor sentiment based on how they're buying or selling in these 5 assets or asset classes. I try to keep it as simple as possible. I try to make the decision process as binary as possible. And I've got 4 indicators, 2 oscillators, price oscillators that I look at: the linear regression slope of the price, different time frames, and I interpret those 2 different time frames: the shorter time frame representing the momentum of the price, and the longer term time frame representing the trend of the price. And I also have a couple overlay indicators. I look at, in particular, a parabolic SAR, stop and reverse, and I also look at, let's just call it a type of moving average crossover, more of a linear regression curve with small modification to factor in volatility. But parabolic stop and reverse, of course, also factors in volatility, and looking at short and medium term trend reversals. And then my regression curve indicator, again, just accounting for volatility, reflects short term changes in price direction. And I tend to use it as support and resistance. So, as of last week, there was a bit of a high correlation developing between crude oil and the US 10-year treasury. They were trading with a positive correlation, and we saw both the 10-year treasury and crude oil prices moving lower over the course of last week. Well, going into this upcoming trading week, the trend on crude oil is still negative, and it's very negative at that. But the momentum starting at the beginning of Friday's trading session flattened out, and as the session progressed, the momentum actually started picking up. So it's still negative, but it's progressively getting less and less negative, and it's just under the 0 line. So a little bit more price support, a little bit more upward movement in oil prices, and we can see that overall momentum shift from negative to positive. Also, with my overlay indicators, the parabolic SAR still reflecting resistance on crude oil, so volatility is low, but the price is right above or showing resistance with my linear curve indicator. So the linear regression curve indicator is signaling support for the price on crude oil. The parabolic stop and reverse has not signaled a price reversal higher yet, but it is very close, as the price is trading very close to the indicator, the plot of the data points. So overall, crude oil looks like it has put in a floor towards its downside move. I see the trend flattening out, which is good. It was getting progressively more negative all throughout last week. But going into Friday's session, the overall trend flattened out. At the same time, on the shorter term measurement, reflects an improving outlook for the momentum. It's getting progressively less negative, which is a good sign. And then the price is using its linear regression curve as support, but is still signaling resistance for the parabolic stop and reverse. So we haven't officially gotten a reversal from that last indicator, but the chart is illustrating support from the linear regression curve, and the momentum on the short-term linear regression slope is turning positive, while the longer-term linear regression slope, its move negative, has flattened out. So, going into this trading week, crude oil seems like it's establishing some kind of a floor. If it can hold support at this level, build some momentum, then we may see a move higher this week in crude oil. But as of now, the prices are falling, but there seems to be a floor or support being established. Very same profile for the 10-year treasury. Over the last week, the price has been falling, starting with the Friday session. The longer term linear regression slope, which I interpret as the trend of the price, plateaued on Friday and actually started getting less negative, starting with the Asian session Sunday evening. The shorter term linear regression slope, which I interpret as the momentum on the price, is positive. It went positive at the end of the day on Friday, and it's continuing its positive progression higher at the start of the Asian session this evening. My overlay indicators, the linear regression curve, or the modified linear regression curve, being used as support, so that's a good thing. But the parabolic SAR is well above the price, indicating that there has been a lot of volatility recently, and so to compensate for that, a reversal won't be signaled until, for instance, the price on the 10-year treasury gets very close to about 132. It's currently trading about 131 and a little bit more than a half, so 131 and a half, let's call it. It needs to get closer to about 132 before we can officially call a reversal on the price, because of how much volatility there has been baked into this price in recent trading sessions. But similar profile to crude oil, the trend is negative but plateauing or putting in support. Momentum has actually gone positive on the 10-year. It's using its linear regression curve as support, but it hasn't quite reversed, or that reversal signal hasn't been quite confirmed from the parabolic SAR. The actual correlations themselves, based on the price action, looks like the strong positive correlation between crude oil and the 10-year is holding. We'll see how that relationship evolves as the week progresses. The other three assets that I look at that are somewhat grouped together but more loosely, I guess, than the other two would be gold, the S&P, and the dollar index. We'll start with gold. Just a visual glance at the chart on gold. Over the past week, it's basically been flat. You may consider a slight upward bias, but for context, gold started the week at about 1722 last week and ended at 1735. So a net improvement of about $7-8 over a week. The longer term linear regression slope, which I interpret as the trend on the price, is positive but has been getting less positive. The shorter term linear regression slope, which I interpret as the momentum on the price, is positive, but it's just sitting there. It's not trending higher, it's not trending lower, it's trending sideways. So the trend is positive, but it's losing its positiveness, and the momentum is flat. Looking at my overlay indicators, the price is sitting right on the linear regression curve, so there's no signal from that. However, it is below the parabolic stop and reverse, so technically that indicator is signaling resistance. So going into this week with gold, we can either expect more of the same flat price action, but because of the slowdown in the growth of the trend, there seems to be some weakness being baked into gold. It's still positive, just less positive. If gold can find support at these levels, being that its trend and its momentum are both positive, it can extend higher, but there needs to be some kind of a reason for it. Otherwise, it just looks like another week of flat gold prices, which is one of the reasons why I decided to start establishing a macro position, and I decided to use an ETF to do that. because I needed to reduce the amount of leverage in the position, because the goal is to hold it over a longer period of time. And I need to be able to sit through short and medium term swings against me. And with a lot of leverage, that makes it a little bit more capital intensive, because then I now have to manage cash around longer term position that I still have conviction in, but may be losing in the short term because of the use of a lot or maybe too much leverage. Looking forward for gold, as of now, it looks like we're going to see flat prices, very little movement. It does have a slight upward bias because its trend and momentum are both positive, but there doesn't seem to be a lot of conviction, at least based on the charts, at this point for gold prices going into next week. I look at it as a buying opportunity because I can dollar cost average into it and just acquire small positions over a longer period of time versus having to chase a market higher that's moving quickly and having to run the risk of committing too much capital too quickly and not necessarily getting a good price. The dashboard chart for the S&P, it's looking like we could have a down week in the S&P. Coming out of last week's trading session on Thursday, the longer term regression slope, or the trend indicator, went negative. And it's been moving decidedly more negative all the way through the Friday session and into the beginning of the Sunday session in Asia. The shorter term linear regression slope, which signals momentum on the price, on Friday started improving. It was negative but started getting less negative throughout the trading session. But as of the short amount of time that the Asian session has been active for, it seems like the short-term linear regression slope is losing a little bit of that upward move towards the positive level. So momentum is slowing its move towards switching from negative to positive, and the trend is moving more and more negative. The price itself is sitting directly on top of the linear regression curve, so that doesn't tell me anything, and it is also decidedly below the parabolic stop and reverse level, which indicates that there was a lot of volatility coming in out of the last few trading sessions, and also that the price has a long way to go before we can get a signal for a reversal. So we're looking at overall some weakness starting off this week's trading session in the S&P. As an investor taking a longer term position, I see it as a buying opportunity, again, to dollar cost average into a position and get better pricing over time. But at the same time, I already have a small position established, and going into the week, I could be looking at losses on those positions. And just for context, the gold position, I started buying both the ETFs but also call options, and I'm laddering my call options out a week. So let's just call it every Friday I should have call options expiring in both gold and the S&P. And the idea is to take the proceeds from those options, the ones that are profitable, and purchase more shares of the underlying ETF. And again, it's something that I've started in the last few weeks. The anticipation is this is something that I would be doing for the next year or so, maybe longer, depending on how robust the move is, or depending on how robust the response of financial assets are to inflation expectations. but the idea is to establish the position and hold on to it while the trade matures. And in the meantime, trade short-term movements in other segments of the financial market. Now we come to the dollar index. Similar to gold, the dollar index has been relatively flat for the last week. The longer-term linear regression slope turned positive towards the end of the Friday trading session. The shorter-term linear regression slope has been positive since the Thursday session. So based on just those two indicators, the dollar is actually moving higher. It's also above its parabolic stop and reverse, which signals support, also shows that the price is moving higher. However, it is sitting on top of the modified linear regression curve, which offers no signal. But overall, it seems like we can expect a week of modest gains in the dollar, which would correspond with lower prices on gold. So going into this week, my objective would be to hedge my GLD options as well as my SPY options and potentially take profits on my hedged positions as the trading week plays out. Now, for forecasting, I typically just look at the same instruments that I look at on the dashboard, but this time I look at a lot more price data. Like I talked about before with the dollar index, I think because of the way international investors are going to use the dollar as a buffer, we're going to see more sideways trading in the dollar. No clear sense of direction. It's currently, or was recently, trading at around 92. And the expectation is to see the dollar bounce around between, call it 93.90 and about 88. It's currently in the middle of the range. From here, it can push higher or lower, either direction. It does seem like the short-term bias is to the upside, but it just means that it has a short-term bias to the upside. With the 10-year Treasury, the chart's a little bit clearer on that one. Last couple weeks, 10-year Treasury got to about 132. That was a significant level on a longer-term time frame. It broke through that. It's now trading somewhat below that. That 132 level, which was a support level until recently, will now be treated as a resistance level. Typically, when a price breaks through a longer term resistance level, it then retraces back to that level, it retests that level, and that's when the price would establish resistance with the level. So you would see that switch from a long-term support to now long-term resistance. We haven't seen that retest yet on the 10-year Treasury. So whether it be in this upcoming trading week or subsequent upcoming trading weeks, even though the bias is lower for 10-year Treasury prices, I do expect at some point to get a retracement back to the 132 level just to clearly establish it as resistance before the price on the 10-year Treasury makes its move lower to the next leg, looking for its next level of support, which is right around 126 3/4. And with the dynamic between the Federal Reserve and how it is interacting with the longer term end of the yield curve versus the federal government, which is planning on borrowing a lot of money to finance its stimulus activities, its recovery activities from COVID. And I think that the longer term move in 10-year Treasuries is lower, but shifts in sentiment, shifts in risk appetite for investors and especially international investors, and also fixed income investors looking for positive yielding sovereign debt will also be interested in buying 10-year Treasuries as the yields go up. So The supply-demand dynamics of that market makes it fairly difficult to establish a macro position in it, at least from my standpoint. But because of the fluctuations in the market, the volatility that is now apparent in the 10-year Treasury market, it also falls into the category of a trader's dream. It has a medium-term bias, but it also has volatility, so you can trade it. The S&P, it's at a level where it's been before several times. It's that 3,900 to 3,890 price range. That price range is significant because it represents the 50% level on a Fibonacci extension on a longer term chart. It is, in short, a significant support resistance level. My approach to trading the S&P 500 around this level is this. The price is above the support resistance. I buy calls. I have a net long exposure. The price is below the support resistance level. I buy puts and I have a short exposure. In this case, because I have been establishing a net long position, when the price falls below 39.80 or that 3,900 to 3,980 price range, I then hedge the positions. So, going into this week's trading session, it looks like I will be looking to hedge my long SPY positions, at least the derivatives part of the positions. But the overall bias, again, from inflation expectations and equities being an inflation-sensitive asset class, as well as monetary policy, and plus short-term interest rates being held close to the zero lower bound, still bodes well for the U.S. equity market. In addition to the fact that the federal government is committing to spending trillions of dollars in the next few years, also means that U.S. businesses should benefit from the increased economic activity from the federal government spending the way it spends. Then there's gold. So gold is sitting right on top of a long-term support resistance level, similar to the S&P 500. It's sitting on the 50% level on a Fibonacci extension on a longer-term chart. The price of gold seems to be using that level as support as of now, so I do have that net long exposure to gold. If I see the price start falling below that 35.25 level, then I can consider hedging those positions. Otherwise, if I didn't have a net long position, I would just start buying puts. I would go short the precious metal. But because of the overall narrative with the inflation expectations, I do think that gold is a long-term beneficiary of that. And I will continue to build that long-term position in anticipation of that, along with the long-term position in the SPY. Then there's crude oil. So crude oil is an interesting case. From a technical standpoint, when it broke through 60, that was exciting because what I think is happening in the oil market is oil prices have broken through $60, which was a resistance level, then retraced back to that level, and I think now establishes that price level as support. From here, the price can then move higher to its next resistance level, which is the 50% on the Fibonacci. This time it's a retracement, not an extension, but still it's a significant level at about $77 a barrel. From there we can expect consolidation, maybe even a small retracement. But if the price can get through that level, then we can easily see $95 a barrel on crude oil. Higher oil prices again lines up with that inflation narrative, with the higher expectations on inflation. leading to higher prices in goods and services. Crude oil being a factor in producing most goods and in providing many services. So, as a major input to see higher oil prices, ties in or confirms the higher inflation expectation narrative that has been developing around financial assets and in financial markets. From a macroeconomic standpoint, I think what we're seeing is we're finally closing the chapter on the disinflation that the global economy, but developed economies in particular, have been experiencing since the great financial crisis of 2008 to 2010. Like I said previously, inflation is the rise in the general level of prices. Deflation would be the inverse of inflation, which would be the falling in the general level of prices. Well, disinflation is right in the middle, which basically means inflation is positive, but it's getting less positive. So you have low inflation and it's getting less positive over time. That's disinflation. It's still positive. Prices are still rising. It's just that the rate of the rise is slowing. Again, more of a second derivative type of analysis. It got to the point where I was considering whether or not the Federal Reserve was stuck in a liquidity trap, which basically means that for as accommodative as monetary policy was, the central bank could not generate inflation. Inflation is needed to raise price levels, which the Federal Reserve and most central banks can easily combat by raising interest rates or raising the cost of money. But with the tools that a typical central bank has at their disposal, and also based on the channels through which monetary policy is transmitted through the economy, the Federal Reserve and most central banks can only create asset price inflation. So we've had a decade plus of monetary policy alone trying to stimulate inflation in the world economy and failing to do so. So we have had growth, we have had economic growth, and we've also had modest inflation. But compared to the level of accommodation that central banks have been providing, we should have had much higher growth rates and much higher inflation. Now that fiscal authorities, governments in particular, are committing in response to COVID to spending trillions of dollars to match the trillions of dollars that monetary policy has also pumped into the financial side of the economy. Now we may actually get to see not just the price of stocks and the price of bonds being elevated, or real estate prices being elevated because mortgage rates are low due to monetary policy, but now we may also see the price of everyday goods and services increasing as the federal government now spends directly into the economy. So the Federal Reserve lowers interest rates and they buy bonds. Monetary policy, quantitative easing. If you do not invest, you do not benefit from the rising share prices where companies can borrow at little to no cost and buy back their shares, or just best case scenario, make capital investments and grow the companies, grow the equity base of their companies. If you can't qualify for a mortgage, or you do not have access to financial services, you don't benefit from monetary accommodation. And surprisingly enough, there's a large portion of the U.S. population that are considered unbanked or do not use typical financial institutions or banking intermediation. So this entire time, none of these people that fall outside of the purview of financial markets have benefited from the trillions of dollars that the Federal Reserve and other central banks have pumped into the world economy. But now that fiscal authorities, governments are committing to spending trillions of dollars as well, in addition to the still ultra accommodative monetary policy stances of most central banks, what I think we can now see is an increase in the price of everyday goods and services as the federal government now creates demand by spending into the economy directly, hiring contractors, hiring people to do jobs, do projects, and they're paying them. These people can now go out into the real world and spend those paychecks and create economic activity from transacting. So, those two things put together, I think, lends a little credence to the idea that we may see a little bit more in the way of general price inflation versus specifically asset price inflation, which only benefits people who have exposure to the financial market and financial intermediation. But, like I've heard said on several occasions, you never let a good crisis go to waste. This is a prime example. If it wasn't for the health crisis and the subsequent economic crisis created by the coronavirus, monetary policy would still be struggling to accomplish something that, by definition, it cannot do by itself, which would be to create consumer price inflation, and specifically for goods and services, not just for financial assets. So, we started this journey in 2010, 2011. It was an economic crisis. Monetary policy responded in unprecedented levels and maintained their accommodation for an unprecedented amount of time. It led to the longest economic expansion in U.S. history, but it also produced some of the largest wealth gaps in U.S. history. In other words, only the people who are in a position to benefit from the asset price inflation saw any kind of benefit from monetary policy accommodation. In the meantime, wages stagnated, and the introduction of automation and artificial intelligence are also helping to suppress wages. That wage suppression will undoubtedly keep the Federal Reserve in particular more accommodative on monetary policy than they otherwise probably should need to be, simply because they are placing emphasis now on the full employment part of their mandate. Before COVID, we saw U.S. unemployment rates at record lows. This was one of former President Trump's favorite bragging points, was how low unemployment rates were compared to historic levels. And yet we still didn't see any inflation. 2020 rolled around, COVID rolled around, and finally governments around the world found a reason to spend. A form of helicopter money, where it literally just drops from the sky. As we've learned from many examples in the past, when you give money to poor people, they typically tend to spend it. Versus giving money, whether it be in the form of subsidies or stimulus or even tax breaks to wealthy people, they don't typically tend to increase their marginal propensity to spend or consume. Instead, they save and invest. That's what wealthy people do. They're wealthy because they have the ability to save and invest. They're only going to save and invest any marginal increase in their income. They're not necessarily going to go out and hire another chauffeur, even though they might buy another Bentley. Long story short, the combined efforts of monetary policy and fiscal policy should, over the medium term, push up inflation expectations. especially if both the monetary and fiscal authorities can communicate on the same page to investors. And that narrative, as it is building in financial markets, will benefit certain assets and certain asset classes. I've personally selected gold and the S&P as two asset classes that are uniquely positioned to ride the wave of inflation and inflation expectations in financial markets compared to other asset classes which, because of their competing narratives or because of fundamental dichotomies in those markets, the overall expectation can be more sideways or choppy trading versus trending. So with the gold in the S&P side of the trade book, the approach or the strategy is more a trend following approach versus with other asset classes like oil, the dollar, interest rates. I think the approach will be more of trading a consolidating market versus a strategy that follows a trending market. And on that note, if you have any comments, questions, or concerns, I can be reached at contact@runthenumbers.biz. That's contact@runthenumbers.biz. This is your neighborhood financial economist, Katie Mark. When in doubt, take profits.